Hello everyone, and thank you for joining today's Trading True webinar. My name is Mohammed Azim from Traders United. I'm excited to be here. First, a disclaimer, a true webinar house rules. Please take the time to read important rules for webinar attendees. Let me start by sharing a little information about myself. I am a certified elite wave analyst, having earned my level 1 certification back in the year 2012 with a score of 93%. This certification deepened my understanding of market behavior, especially through the lens of elite wave theory. In addition to my work as an analyst, I'm also an author and educator. I wrote Introduction to Elite Wave Theory, a book designed to help traders like you build a strong foundation in understanding the intricate structure of market waves. But my expertise does not stop at elite wave. Over the years, I have expanded my knowledge into broader market analysis, diving deep into market trends, chart patterns, and price action strategies. So whether you are a beginner or an experienced trader, I aim to provide you with valuable insights that will help you navigate and succeed in the Forex markets. With that, let's dive into today's session. These are the main topics that we are going to cover inside today's webinar. Let me talk about macroeconomic events and data releases. I'm going to cover previous week fundamental analysis. Let's start with the official cash rate, OCR. Now, what is the official cash rate, also known as OCR? OCR is just a short name, it's an abbreviation. The official cash rate is the benchmark interest rate set by the Reserve Bank of New Zealand. It serves as the primary tool for influencing short-term interest rates, aiming to control inflation and support sustainable economic growth. Adjustments to the OCR directly impact borrowing costs, consumer demand, business investment, and overall financial conditions. The RBNZ, meaning the Reserve Bank of New Zealand, typically raises the OCR to contain inflation and cool an overheating economy, while a rate cut is used to stimulate growth by lowering the cost of borrowing. Now, on May 28, 2025, we got the OCR announcement results. The previous number was 3.5%, the forecast was 3.25%, and the actual number we got is 3.25%. As expected, the Reserve Bank of New Zealand cut the OCR by 25 basis points to 3.25, in line with the market forecasts. The central bank emphasized a cautious approach to further easing, citing a gradual slowdown in inflation and softening economic activity. However, the overall tone of the accompanying statement was less dovish than anticipated. Now, let me show you the chart of NZDUSD currency pair. So the market impact on New Zealand dollar versus US dollar is that despite the rate cut, the NZD USD currency pair moved higher following the announcement. This reaction suggests that market participants had priced in a more dovish scenario, possibly expecting a signal of further aggressive easing. Instead, the Reserve Bank of New Zealand's relatively measured tone and lack of commitment to immediate additional cuts provided short-term support for the New Zealand dollar. Now, the official cash rate, the expectation was 3.25%. That was the forecast, and the rate cut matched the forecast. The absence of a strongly dovish signal limited further downside for the NZDUSD currency pair. So the Reserve Bank of New Zealand neutral to cautious tone was interpreted as less aggressive than markets had feared, leading to a rebound in NZD-USD currency pair. Although the Reserve Bank of New Zealand followed through with the widely anticipated 25 basis cut, the accompanying guidance did not signal an urgent push towards further easing. This helped ease bearish sentiment around the New Zealand dollar and led to a short-term recovery in NZD-USD pair. The pair's upward move suggests that traders had positioned for a more dovish outcome and were forced to adjust on the less accommodative tone. So the conclusion is, on May 28th, the OCR decision confirmed market expectations of a 25 basis cut, but the relatively restrained tone of the Reserve Bank of New Zealand statement helped lift New Zealand dollar versus USD pair. For traders, the key takeaway is that the future NZD direction will continue to hinge on evolving Reserve Bank of New Zealand guidance and incoming economic data. The Kiwi may remain supported in the near term unless clear signals of deeper easing emerge. The next important economic event and data report is the GDP M over M in Canada. M over M means month over month. Now, what is GDP? GDP stands for Gross Domestic Product, and it measures the monthly change in the total value of goods and services produced in Canada. It is a key indicator of short-term economic health and momentum. As one of the most influential data points, monthly GDP figures shape expectations around Bank of Canada monetary policy. A stronger reading typically boosts the Canadian dollar, while a weaker number can weigh in, especially if it shifts the rate outlook. Now, on May 30th, we got the number at 0.1%, which is above from the negative territory. The previous number was minus 0.2%. The forecast was 0.1%, and the actual number is also 0.1%. So the Canada's economy showed modest growth of 0.1% in line with expectations and making a rebound from the prior month's contraction. While the improvement was not dramatic, it suggested a degree of underlying resilience in the Canadian economy. Now, the market impact that we got on the USDCAD is the chart of USDCAD. Despite the GDP figure matching expectations, USDCAD dropped, reflecting Canadian dollar strength. This move suggests that markets were positioned for a potential downside surprise or interpreted the data as a sign of economic stabilization, reducing the urgency of near-term Bank of Canada rate cuts. So the GDP matches the expectation. The forecast was 0.1%, and the actual number is also 0.1%. So this is in line. The result typically prompts a muted market response. However, in this case, the CAD strengthened likely because the data helped ease concerns about ongoing weakness. The modest rebound reassured markets that the economy may be regaining traction, driving USD CAD lower. So the overall analysis is while the GDP growth met forecast, the market interpreted it as a positive development following a prior contraction. The Canadian dollar gained and USDCAD currency pair fell, reflecting reduced expectations for immediate Bank of Canada rate increasing. The reactions highlight that in a context of low expectations, even meeting the forecast can be CAD positive or CAD supportive. So the conclusion is the May 30th GDP month-over-month data release confirmed a modest but welcome return to growth in Canada's economy. With the CAD strengthening and the USD-CAD declining in response, traders viewed the report as stabilizing rather than disappointing. Going forward, markets will watch for sustained improvements in Canadian data, meaning the financial data, to assess the Bank of Canada's next steps. Next one, we do the previous week global market trends. I'm going to discuss the euro dollar and USD Swiss franc currency pair. Let's take a look at a price chart of euro dollar currency pair. Now, we know that in euro USD currency pair market went up quite high. Uh, this looks like to me kind of a nice bullish breakout over here, and now price action is trying to stay up over here. The weekly RSI looks overbought, but price action still going up. If you check out the daily, you might see some drop in price action. So over here in daily chart of euro dollar currency pair, this was the support. Market tried to stay below this level and then rallied back up. I was actually expecting market to move sideways. So basically this is what we are getting right now. The USD Swiss franc obviously showed us kind of a bullish price action or a scenario over here. Over here you can see the USD Swiss franc, it's trying to rise up. And let me change the template. Okay. So if you take a look at a daily time frame, the daily time frame shows that price action is trying to find support over here, but this isn't enough. It's quite possible that price action is going to drop more before it actually finds some aggressive buyers, and after that it might tries to rise back up. So the way I see USD Swiss franc is probably going to move sideways. It might drop a little bit over here after that, but then market is going to provide some strong and aggressive buyer pressure or buying pressure, because the support that I see, it's down over here. This is the level which provides most likely aggressive buying spot. So I would say that's my buy zone over here. Next, let's go over to the current week macroeconomic events and data releases. The first one is the construction PMI related to United Kingdom, and the currency pair we're going to discuss is the British pound versus United States dollar. And we expect the report to come out on June 5th at 8:30 a.m. The next one is the non-farm employment change. This is also known as non-farm payroll data report, and it's going to be the USA report, and the most affected currency pair is the euro dollar currency pair. The report comes out on the first Friday of every actually the first week of every Friday, first week of the Friday of every month. So on June 6th, 12:30 p.m., that's the time we will get this report. Let let us take a look at some more details. So what is the construction PMI? Well, the S&P Global UK Construction Purchasing Managers Index, also known as PMI, is a monthly gauge of construction sector's health in the United Kingdom. Compiled from the survey response of purchasing managers across residential, commercial, and civil engineering sectors, the index tracks key indicators such as business activity levels, new orders and client demand, employment trends, input cost, and supply delivery times. PMI reading above 50 indicates expansion, while a reading below 50 signals contraction in economy. So, as a forward-looking indicator, construction PMI provides early insights into economic momentum and potential shifts in monetary policy expectations. So on June 5th, 2025, the construction PMI, well, the previous number we got is 46.6, which is still below the 50 level, and the forecast is about 47.4. The actual data is going to be released on June 5th. So the UK construction sector has remained under pressure in recent months, with the previous reading of 46.6 confirming contraction. The upcoming data is forecast to show a modest rebound to 47.4, still in negative territory, meaning still below the 50 level, but hinting a stabilization, a modest stabilization, I would say. So markets will be watching closely for signs that activity is bottoming out or deteriorating further. Now, the market impact on GBP USD is GBP USD tends to react to significant deviations. Let me show you the chart of GBP USD currency pair as well. Let's take a look at a weekly time frame over here. Okay, so GBP USD tends to react to significant deviations from PMI expectations, especially in the absence of larger macroeconomic drivers. While construction represents a smaller slice of the UK economy compared to services or manufacturing, the report can still influence short-term sentiment, particularly if it aligns with or contradicts broader economic signals. Now, if PMI beats the expectation, meaning we get a number that is uh, greater than 47.4, then it means it's a stronger than expected reading, and that would signal resilience in the construction sector and could boost GBP USD, especially if it adds to evidence that the UK economy is stabilizing. A move closer to the 50 threshold might ease recession fears and reduce dovish expectations from the Bank of England. And if the PMI matches expectations, becomes equals to 47.4, if that's the number we get, then that result is in line with forecasts, which may have limited market impact. Market might move sideways. If you take a look at a 4-hour time frame, let's take a look at the 4-hour chart. It seems to me market is trying to go nowhere. I do expect price action to move sideways over here. Let's take a look at the daily. So this is the next level. Let's move this one over here. So we have a pretty good support at 1.3437. Let me change the number. 3437. So that's the number. This looks like to me a strong support level, and a break below this level is going to provide some weakness in price action, but for the time being, the GBPUSD is staying up there. So the overall analysis is that the UK construction PMI remains below the 50 threshold, pointing to continued contraction. Although a slight rebound is forecast, the broader outlook is still fragile, and traders will look beyond the headline for signs of improving demand or employment trends that could hint at recovery or confirm deepening stagnation. So the conclusion is that on June 5th, construction PMI A release may not be a major market mover on its own, but in the context of soft UK data and heightened sensitivity around central bank policy, a meaningful surprise could shift sentiment around the British pound. The last but not least is the non-farm employment change, also known as non-farm payroll data report. Now, let me explain a little bit what is non-farm employment change, also known as NFP. The non-farm employment change, the NFP report measures the monthly change in the number of employed people in the USA, excluding farm workers, the government employees, and non-profit staff. It is one of the most impactful data releases in global markets, offering a real-time snapshot of the US labor market. Now, the data is basically released by the Bureau of Labor Statistics. The NFP report is closely watched by traders and policymakers alike. So, strong job growth tends to bolster the US dollar by reinforcing expectations of higher, I would say, expectations of tighter monetary policy from the Federal Reserve, while weak reading may lead to a more dovish stance. Now, the previous number we got is 177K, and the forecast is quite less. The expectation is 130K. The actual data is going to be released on June 6th, 12:30 p.m. So markets are bracing for a slowdown in USA job growth, with forecasts calling for a gain of 130K jobs in May, down from 177K, the previous month number. This cooling trend reflects broader signs of deceleration in the USA economy and has added pressure to the United States dollar in recent sessions. For example, let me show you the chart of euro dollar currency pair. You can see euro dollar just keep going up, up, up. Overall, it looks bullish. If you check out the weekly time frame, same story. The weekly chart looks bullish. Okay, so historically, Euro USD is highly sensitive to NFP surprises, with expectations already set for a soft reading. The reaction will depend not only on the headline number but also on wage growth and the unemployment rate. Now, if the NFP number beats the expectations and we get greater than 130K number, then that print could revive bullish sentiment on the US dollar, the DX, and prompting a reversal in Euro USD, and Euro is going to fall. It's going to drop. Okay. And if we do get the 130K number, then obviously euro dollar is probably going to rise up more. I would actually expect euro dollar to move sideways or overall bullish. So uh, if the NFP becomes even less than 130K, then obviously that would be quite a weak report and could deepen recent US dollar softness, potentially triggering a further rally in euro USD. However, with bullish sentiment already elevated, any upside move may be limited, setting the stage for a possible exhaustion top in euro dollar currency pair. So I'm actually expecting a top in euro dollar currency pair because the euro dollar has recently been climbing on the back of softer US data and moderating Fed rate expectations. However, the pair is now approaching key resistance zones. We have some resistance level up here as well. If I go to a monthly time frame, you see we have some zones over here, another one a little bit up here, and then another one right up there. So we have some resistance levels up there. The market looks already overbought in weekly time frame. So some kind of a top or a sideways price action is probably going to start for next coming trading weeks. Okay, so a top formation, it could materialize if the Euro USD fails to break above a recent high with conviction, and the NFP triggers a sharp USD recovery. Okay, so the overall analysis is the June NFP report is a critical event for Euro dollar traders, especially given the pair's recent strength. While the market is pricing in a slowdown in USA job creation, the dollar remains oversold on several fronts. If you check out the euro dollar, it's overbought, so it means the uh, we could get some kind of a top over here. If you check out the NZDUSD currency pair, go over to a weekly time frame, and let's add this template over here. Give me a second. So here, see the NZD USD, it's kind of becoming overbought over here. And if you take a look at Aussie dollar currency pair, let me show you this as well. The RSI, it went near to 70 level. So we might get a top, in euro dollar currency, or I would suggest a sideways price action overall. But the trend remains up in euro dollar. So the conclusion is, with euro dollar approaching key resistance levels and the market potentially overextended to the upside, the June 6th NFP release may serve as a catalyst for a top, and traders should watch for a shift in momentum, especially if the jobs data comes in stronger than forecast or alters Fed rate expectations. A reversal pattern in the aftermath of the release could offer high probability setups for US dollar bulls. Okay, next let's discuss the euro dollar, Australian dollar, GBPUSD, the British pound, and the spot gold. Okay, so as far as the euro dollar is concerned, like I've just discussed, it looks bullish. The way I see it's an uptrend going on inside euro dollar currency pair. Same story inside the daily chart. Market's probably going to move sideways, but overall I expect further upside. Okay. Next, we have the Australian dollar. So AUD USD currency pair, in a weekly scale, you see we got quite a bullish rally over here. And if you check out the daily time frame, the RSI is somewhat showing overbought reading. If you go to a 4-hour time frame, it's already overbought. But overall, it just keep printing new highs. So I would say price action is moving up. It's printing higher swing highs and higher swing lows. If we do get a breakdown in price action, like if Aussie dollar, tries to breaks below this support level at 0.6355, let me write it down. 0.6355. If price action breaks this level, then we might get further drop in price action. But overall, I think it's just going to move sideways and then expect further upside. Next one is the GBPUSD currency pair. Okay, the pound dollar. Well, the currency pair looks overbought, and we could get a top over here, but based on these previous breakouts, the way I see GBPUSD is most likely going to continue the bullish price action. It's most likely going to rise up further. Next one is the spot gold. Spot gold, I was expecting a pullback. We got the pullback, and after that, I was expecting a bullish leg, and that's what we exactly got in spot gold. But the way gold is moving, I would say that we might get some kind of a, you know, we might get some kind of a bearish price action before market actually resumes the uptrend inside spot gold. The overall trend is obviously up. Price action just keep printing higher swing highs and higher swing lows. So there's a nice uptrend going on inside spot gold. Okay, that's pretty much it for today. So we have learned today about the construction PMI related to UK, the NFP report, and we also discussed the euro dollar, AUDUSD, GBPUSD, and spot gold. These are the trading instruments. These are the assets you need to watch out for profits. Uh, you can stay tuned for schedule of next week's trading webinar. You can subscribe to our social media pages. And if you are interested to learn more about trading, visit the Trade Geek and access free trading courses for beginners, intermediate, and expert traders. Thank you for hanging around. See you at the next trading webinar on Tuesday, June 10th, 2025 at 12 p.m. UTC time. So that's it for the time being from my side. Have a nice day and bye-bye.